A USDA-backed loan is a transaction whereby a client applies to a bank or a non-bank lender for financing. The lender agrees to make the loan, and then the lender submits the application to the USDA for a partial guarantee. The first reason is loan size. Community and local and regional lenders usually cap out at roughly 5 to 10 million of conventional financing. Larger banks, Wells Fargo's, Chase's, those kind of folks generally don't get involved until it's about $50 million. So what do you do if you're in rural America and you have a loan request that's between 10 and 50 million? Well, the USDA is a great option for you. Well, the reasons are numerous, but start with underwriting flexibility, the ability to offer long-term fixed rates, higher leverage, lower down payments, and longer terms. So generally we can go anywhere from 25 to up to 40 years, fully amortizing. A rural small business or tribe or city applies for a loan as they approach a bank or a non-bank lender. The lender agrees to make the loan, and then the lender submits the application to the USDA for a partial guarantee of that loan. There are a number of advantages for rural entities that want to apply for credit through the USDA loan guaranteed programs. First and foremost is flexible underwriting. So we have the ability to lend on future projections, which is unique as compared to conventional lenders. Beyond that would be the long terms. We can go anywhere from 25 to 40 years. The longer the term, the lower the payment. We also offer construction to permanent financing rather than breaking those two up. And it's just one seamless close for the borrower. Most of the USDA 1RD loan programs have to be funded to projects that are in rural America, but the USDA does have a couple of transactions that they like to focus on, and they will give us the ability to broaden the geographic reach, including lending even if a project is in a city. So the first one is what's called the Local Foods Initiative. That's for a project that grows and distributes food locally, defined as 400 miles or less in radius. The second type of focus for the USDA is renewable energy and/or renewable chemical transactions. So in those scenarios, a project may be able to serve urban and/or rural markets. Applicants may wonder what the interest rates are like for USDA guaranteed loans. In general, they're commensurate with local and regional banks. However, the USDA does have add-on fees like SBA or like FHA or any other government guaranteed program that will raise the interest rate slightly. Borrowers can use USDA-backed loans for refinancing as long as they can demonstrate that on a historical basis they can service the debt based upon the new terms offered by the USDA guaranteed loan. Creative loan structuring is one area where USDA shines beyond the other government guaranteed loan programs such as SBA or HUD or similar programs. USDA will allow us to put more than one program together for a companion. So we might be able to pair a B&I loan with a REAP loan or a community facilities loan with a B&I loan. So that's a big advantage. But USDA is also very accommodating to other types of financing and grants such as the investment tax credit, historic tax credit, new markets tax credit, commercial PACE, mezzanine financing, and the like. Applicants have been challenged when looking for debt between $5 and $15 million. One reason is that the companion program, the corollary program, is the Small Business Administration. It caps out at $5 million. Beyond that, local and regional banks have a difficult time in offering fully conventional loans without a guarantee. The USDA fills that slot between 5 and 15 very well, and even 15 to 50 million. USDA loans are underwritten just like a conventional bank loan with two additional requirements. Number one is USDA requires an independent third-party feasibility report anytime the loan is based upon future projected income. Secondarily, once the lender is finished with their underwriting analysis, they will submit that transaction to the USDA, and the USDA will independently analyze each transaction and approve each transaction. The repayment period for a USDA-backed loan depends upon the use of the funds and the collateral offered. For example, if a rural entity was to purchase equipment, that would likely be offered a loan term of 10 to 15 years. For any small business looking to purchase real estate, that might be a term of 25 years. For towns or water districts or fire districts, a term of up to 40 years may be viable. The longer term is critical for those rural small entities that can take advantage of lower payments because of the longer term. First of all, if you're a rural small business, you should have all of your equity raised or near term to be raised, because these programs do require down payments. For real estate, that's generally 20 to 25% down. For equipment, it might be up to 30%. So it's best not to approach a lender or the USDA until equity has been secured. From there, what is extremely valuable and a great investment for a real entity is investing in a third-party business plan or financial summary. That will provide the sources and uses, background on the management, the market, projections, what have you. That really helps to expedite the process. One of the weaknesses of applying for a USDA-backed loan is the long time frame. So the USDA is going to receive and reanalyze each and every transaction, and that does take some time. However, there are a number of lenders that are willing and able to offer a bridge loan once they know that a loan has been submitted to the USDA and the USDA has a complete package. Applicants that choose to obtain bridge financing may wonder how much to apply for. Well, it depends upon the use of funds. For example, if an applicant is looking to purchase or refinance a loan on a building, then they will necessarily need 100% of the funds available on the day of closing. Bridge lenders may ask the applicant to put up, on a short-term basis, additional equity until the USDA approves that loan request. Similarly, for a construction transaction, not all of the funds have to be available on day one, since only a small percentage is going to disperse on the day of closing and for the month or two thereafter. USDA loans are superior to other types of government guaranteed loans because USDA invites other financing sources. So examples could be commercial PACE, which are often paired with business and industry loans, or the various tax credit programs, including investment tax credits for renewable energy, historic tax credits or new market tax credits, TIF financing, mezzanine financing. All of that is allowed and invited by USDA. The process to apply and to receive funding for a USDA loan is similar to that of any other commercial real estate or equipment loan. Namely, you apply to the lender approves, then it moves on to the closing process and the construction disbursement process. The key difference with USDA is in the middle. Once a lender approves a transaction, that lender then must submit the transaction to the local state office for approval. And then once the loan is approved by the USDA, then the remainder of the process continues, again, including closing and construction disbursement or loan servicing if there is no construction. First and foremost is the address, since address determines eligibility. And then from there, some sort of financial summary that includes both the sources and uses, background on the management, an ownership structure chart, and projected revenue. USDA loans have a lot of great benefits, like other U.S. government guaranteed programs, but like those other programs, USDA loans can take a little longer than we would like, or that can facilitate a transaction that has a short closing window. So what we've done is we've developed a few different bridge opportunities for both construction and purchase transactions that allows us to go ahead and fund a transaction prior to even getting the USDA approval. The way the bridge program works is that we as the lender have to be very comfortable that a USDA approval is going to be forthcoming. So what we will do is we'll collect all of the due diligence information, we'll start the reports, and then we'll submit what's known as a preliminary eligibility review to the USDA to get their concurrence that this is an application that is actually eligible for USDA financing. Based upon their response and our comfort with the file, we will move to go ahead and close the loan. We still do need to have an appraisal because it's a commercial real estate transaction. But once the appraisal comes in, once the environmental report comes in, we're going to be in a position to close. That can usually be between 45 and 60 days. The ability to pair USDA with other product types is becoming more and more popular. One of the big reasons is we can use other investment in lieu of a portion of the equity of a client. Raising equity is difficult, it's expensive. We can often use these other programs to bring in lower cost financing that can offset equity. Applying for a USDA loan is the same as applying for any conventional loan in that you're applying with a lender. It's the lender that then applies to the USDA for a partial guarantee. So you'll work with your lender to submit an application package, go through the due diligence, order reports, complete the underwriting, and then once the underwriting is complete, then the lender will submit the application to the USDA for their approval. Once the USDA approves, then it'll go back to the lender to complete the normal closing process, including funding through escrow or dispersing construction, just like any other commercial loan that you might apply for. So a USDA loan application starts by submitting 4 key items to your lender. So the first is a financial summary. 2 is a sources and uses, so we can see what your budget is and what the line item allocations are for your budget. 3rd would be an organizational chart, and 4th is description of the management team and any relevant experience they might have in the industry.